Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 241st VideoCast podcast for the week ending May 30th, 2024. A lot of great stuff to cover today. A couple quick updates. The girls kind of had off, so not a whole lot there this week, but this is in front of the News Corp building when I went to do Cavuto Coast to Coast yesterday. For those of you who are newer, who haven't seen the behind the scenes photos, that's the Empire State Building. Never gets old. That's out in front of our place there on Bryant Park. And then this is the bullpen at Fox Business, Fox News on the second floor where the pods are. So that was a lot of fun. Want to thank, obviously, Neil Cavuto and Jenna DeTomasis for having me on the show. It was very exciting to do that. And we shifted gears on the notes that we were going to talk about a couple hours before the show. Was fantastic. We got to talk about the Fed, got to talk about the U.S. consumer, got to talk about outlook, and got to talk about some opportunities in the second half of the year. So we're going to listen in now.
You know, they always say it's not so much the earnings, it's the guidance that companies give. And American Airlines hitting some severe turbulence, its stock dropping about 15% on news that, well, its guidance wasn't exactly upbeat. It sees things slowing down, planes maybe not as full in the future. It follows a pattern we've seen of late of some premier companies saying things are slowing, whether you're talking Home Depot, McDonald's, Starbucks. They're all in that same camp where things might be showing consumer retrenchment. Thomas Hayes is a Great Hall Capital chairman and managing member. Genius with money. So, Thomas, when you look and hear these companies saying, not every one of them, but more of them, we've got a consumer pullback going on here. But what does that tell you as an investor?
Well, the one thing I've learned, Neil, over the years is that to never bet against the U.S. consumer when they have a job. And with unemployment under 4%, I think this says a lot more about American Airlines management than it does about the U.S. consumer. They've been running this business like a dog chasing their own tail, rather than looking through the windshield at the consumer, the business traveler coming back. They've been looking in the rearview mirror at the revenge travel spending, which is actually waning. So the companies that have managed their business well, like Delta, you see American Airlines down today about 15%. Delta, which is a well-run airline, is only down 1%. So that tells you everything you need to know here.
That's a very good point, Tom. So I'm going to steal that and say it was my own. So, Thomas, let me get your take on this, because other companies are finding ways to help their shoppers. I noticed Walgreens is cutting prices on 1,500 plus items at Target. We've seen Walmart, Amazon doing variations of the same thing. So they are trying to respond to this. What do you make of it?
Yeah, even Dine Equity, which is Applebee's, is offering a lower price menu. I think this is disinflationary. You know, we've seen the pendulum swing so aggressively from expecting 7 cuts at the beginning of the year to less than 1 cut now. I think it's somewhere in between. And I think this kind of sell-off and this little volatility we've seen in recent days where everything's just going into NVIDIA and some of the perceived safety stocks is temporary. I think we're actually going to start to see, we'll get some inflation numbers at the end of this week. That 1 to 2 cuts is actually realistic this year. And if that happens, that broadening that started in the rally and we've started to see is going to extend. And you're going to see small caps and you're going to see dividend payers. Once that short rate goes below 5%, dividend payers have been very, very neglected, and they're going to be a huge opportunity for the back half of the year, Neil.
Wouldn't the market, we don't have much time, quick thoughts on the first cut might be greeted by a sell-off? That maybe, you know, in anticipation, maybe go up, but the actual event go down?
Buy the rumor, sell the news. It's always possible, but I think it's very good. There's a lot of debt that needs to be refinanced, Neil, especially among the small cap companies. So you might get a buy the rumor, sell the news, but I think when companies go to hit the window and refinance, analysts like myself and portfolio managers are going to see that these companies' balance sheets are better off for it, and we're going to get a resurgence in that broadening that we discussed.
All right, we shall see. Thomas Hayes, good seeing you again. The Great Hall Capital chairman and managing member. It's an interesting way to step back and look at the big picture, as he does.
And we're back. The quote of the week is from Ray Dalio. The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. I was thinking about this quote before the podcast. This is basically our business is predicated on this. You know, people tend to fall into a recency bias, and the opportunity is benefiting from the dislocation more often than not when you have massive dislocation. People think that that's going to persist in perpetuity. And we like to take the other side and benefit from that dislocation on the basis that what has happened in the recent past may not necessarily be what's going to happen. As a matter of fact, we like to zoom out and look at the longer term trend and say, yeah, they've been through these type of cycles before. The business is quality. Then we do our solvency risk. Then we do our free cash flow analysis. And then we look at the business and we look at management and we start the process. And I think this sums it up nicely in one sentence. Getting caught up on the charts from Robert Slumer over at RBC. Thanks to my buddy over there. You know who you are. Not much update there. It's just kind of testing this level out here on the S&P, testing this support level here on the S&P, which we talked about last week. Russell Small Cap Index still looks in favorable condition. That is going to be, we're going to get Fed dot plot in a couple of weeks. And we're going to talk a little bit about how that could impact the yen, but how it's also going to impact a lot of these other groups, from dividend payers to small caps to emerging markets, et cetera, which we've been talking about for some time. For those of you who've been around. And here we talked about that. No difference in the topics in Japan. That's coming up against resistance. I wouldn't be surprised if this is serious resistance for that. And then this is the chart I wanted to cover. The Hang Seng, if you remember last week, it was up here. I said, look, we've run into this 61.8% level that Robert Slumer points out here. It wouldn't surprise me if we bump around for a few weeks, consolidate these massive gains since January before moving to the next level. And that looks like exactly what is happening. So that is going according to script. Not fun, but if you zoom out and put it in perspective, it's just completely natural, and that's part of the process. The other one that I love is the 10-year yield weekly chart is holding in place nicely with these yields. As I continue to say, we're going to see below 4% on the 10-year yield before we see above 5%. This was a counter trend bounce. Looks like it's putting in a head and shoulders top. I can't believe these words are coming out of my mouth, but when the fundamentals are a little bit silly, you pay attention to some of these squiggly lines. And then so that's the 10-year yield. This is the dollar, same thing. Counter trend move seems to be rolling over. This is important trend line support. I think it will break down through that, if not from tomorrow's core PCE, which we can't predict. But then from more likely than not, the dot plot, because now expectations, as I said with Neil Cavuto, expectations have swung so far from 7 cuts to like no cuts. I think the dot plot's going to show 2 cuts this year, and that's going to shock people, and this is going to bust right through. And same with the 10-year yield, and that will just accelerate everything. Emerging markets, China, small cap, dividend payers, biotech, you name it, we got it. Here's my favorite Canadian dollar for my Canadian friends. All right, I better move on before you all think this is Groundhog Day and we're doing last week's seminar this week. This is from Jim Paulson, who I talk about. He's one of my favorite sell-side analysts for many years. He's retired, but he writes this thing on Substack, and he's basically talking about credit spreads signal recessions better than any indicator, and he's showing that credit spreads are showing no signs of stress, and therefore the idea of a recession is sometime off, and we agree. Sentiment survey, which we didn't get to put in last night because we were writing until 2 in the it came down. Bullishness came from 47 to 39. This is neutral land, basically 30, 30, 30. And National Association of Active Investment Managers came off the boil a hair, but it's still elevated. This I thought was interesting, the TSA checkpoint traveler throughput. This is one we used to cover every week during the pandemic. We haven't covered in a while, but it's now finally above pre-pandemic levels and been consistently above there. So that kind of falls into place with some airlines are getting it right, like Delta, looking forward to capture the business consumer, and other managements look in the rearview mirror. Remember what happened recently, they think is going to persist. What happened recently? revenge travel. Okay, so American Airlines was looking in the rearview mirror, trying to capture something they missed, expanding in the small markets where there's overcapacity. And then Delta was focused on the business traveler, which wasn't quite coming back. Now it's coming back full steam, and now they've got the advantage. And we see that in the relative performance. Moving right along. US M2 money supply. For those of you who are listening this week, it's probably a good week to watch. We've got a lot of chart data that gives you an advantage to actually see it visually. You can get it on the YouTube channel, Hedge Fund Tips. Just put it into the search bar. It'll come up. US M2 money supply year on year. This is a big deal. It peaked right at the peak of the market. Then you had that crash in 2022, continued down to early 2023, and now has been recovering. And in April is up 59 basis points. So more and more money supply. That's positive for liquidity, for markets, for everything. S&P 500 equal weighted versus the S&P 500. This is exactly what you see right before massive recoveries. You saw it in March of 2009. You saw it in the COVID lows. And now you're seeing it in 2024. Off of these type levels is where you see rip-roaring small cap rallies, rip-roaring cyclical rallies, all the stuff that no one wants right now. They're gonna be tripping over themselves, and it's gonna happen imminently. And we've talked about what the catalyst might be for that. China saw record bank withdrawals in April. This is very interesting because I think what this is indicating, because they've had record savings, and Joe Tsai talked about it, there's no consumer in the world that's better set up. They have the capacity, now they just need the confidence. And it looks like that confidence began in April as they started to finally draw down some of their deposits and circulate it in the economy. And there's just an avalanche of that available moving forward. And we'll see that reflected in consumer spending in China. US dollar to Japanese yen. If you talk about what we were talking about weeks ago, when the Bank of Japan finally intervened, you can see what's happened since. This is a huge story for all of our theses. As the yen weakens, that's going to help. As the yen now strengthens because the Bank of Japan is moving into restrictive territory, whereas the rest of the West is moving into easing territory, which will lead to weaker dollar, which helps emerging markets, China, you name it, and how we're positioned, which is exciting. Dallas Fed service sector input prices are collapsing, so hopefully we'll start to see more of that evidence in tomorrow's numbers. Rich, by the way, tonight I'm going to be on Bloomberg Daybreak Asia at 8:42 p.m. You can listen into that. Richmond Fed service sector, current service average wages. Wages are coming down. Again, that's another inflation component. Richmond Fed manufacturing index showing some recovery back into expansion. That's been in a recession for 2 years. Okay, proportion of S&P companies mentioning the term. Okay, so they're now moving from pricing power, so their pricing power is in the rear view mirror. They basically would charge anything they could get away with. And people that are saying like, oh, look at Burger King and look at all these companies that have to lower the prices for the consumer now, they're still way above what they were. What they basically did was they jacked it up as much as they could possibly get away with. And now they can't get away with it, but they're still at levels that well exceed anything pre-pandemic. So now they're focusing on expense management versus gouging the customers. That's not necessarily a sign that the consumer is done. It's more a sign that the consumer is done getting jammed and they're not going to take it anymore, and companies have to move to a normalized level somewhere in between where they were pre-pandemic and where they were at the peak when everyone had or many people got tons of excess cash from the government for spending. That's now run out. Disposable income and employee compensation has outpaced inflation since the pandemic hit. So what this is basically saying is that the consumer has outpaced consumers' earnings and income have outpaced price growth. This is from Carson. That is Sonus Vagese and Ryan Dietrich. Beige Book activity shows the economy is doing fine. You see this recovery off the 2023 lows. And then Advanced Auto Parts was up big today. They reported earnings. First it was down. Now it's up. I think the name of the game here is that like all recoveries, one is they took guidance up a bit, which is great. They took top line up a bit, which is key. Comp store sales up, free cash flow guidance up. So everything's moving in the right direction. And then they sell that Canadian Westpac business. They'll delever, their interest expense will go down, and they'll be off to the races. So I like that story, and I continue to like that story. Thanks to Paul F. for sending me this basically while I was recording. And what that is if you remember, we had an Ask Me Anything question about Lululemon. And it's come down a bit. And I said, look, yeah, it's got a 2 handle. Maybe I'll start to look at it again at 250. I don't like the fact that their chief product officer left. I do like the business, but she was amazing. I'm not crazy that she left. And guess what happened? They just announced today, while I'm recording, Paul Falcone sent it to me. Where did she go? She's running Vans, baby. This is exciting. This was the chief product officer at Lululemon for the past 7 years, leaving Lulu, gonna run Vans as global brand president. I mean, if you could pick anyone in the world to turn around Vans, who would it be? It would be this lady named Michelle Sun Coe. And very, very exciting news. I didn't see if there was any impact in the after hours. She'll probably have to prove herself. People are skeptical on the stock, but this is good news. I had some people in mind that I thought would have been good, but nothing in this ballpark by a mile. Okay, second best S&P performance, first 100 days since 1930. When the S&P is up at the 100-day mark, the average return for the rest of the year is plus 10.1%. That's via Mike Zaccardi, via Seth Golden, via Bank of America, via. Good ideas have a way of traveling. Carl Nia forwards this Bloomberg headline: Bostic don't see cut in July, but open if data justify. That's kind of a different tack. I mean, everyone, Fed speaker in the last few weeks, has been shooting down anything near term. The fact that he's open if the data comes, which means he'd only get one good report ahead of that, maybe two, tells me that they're acknowledging the level of restrictiveness that I've been pointing out. Williams said ample evidence monetary policy is restrictive. You think? With short rates 200 bips above inflation, that's massively restrictive. The issue is if they wait too long, when it finally turns, it turns hard and they won't be able to catch it. It'll cost them a lot more. And that's why I continue to say if they did one early, they might only have to do 1 or 2 cuts, and that would be it. If they wait too long, it's going to cost them a lot more. This indicates that they're aware of that. We'll see what their actions do relative to their words. ECB may beat the Fed to cutting rates. Here are the risks. Look, the easing cycle has begun. Switzerland's already eased. Sweden is already eased. ECB is going to ease. We're going to see the dot plot in a few weeks, which should indicate more cuts than the market is pricing in, which will have a positive shock to the market, which probably spurs this summer rally that we're going to talk about. That's historically significant in the 4th year of a presidential cycle. Google, set to make its largest acquisition ever, threatening Microsoft. Google's purchase of HubSpot is in line with its goal to take market share from Microsoft, according to one analyst. So this was out last week as a rumor. I don't know that this is confirmed yet, but where there's smoke, there's fire. I think that's going to be a positive outcome for Google. European Central Bank says monetary policy to ease gradually as markets brace for June rate cut. That's good news. PayPal is planning an ad business using data on its millions of shoppers. Parent payments company hires Uber's former head of advertising to run a new ad division. If you remember, Uber took off when they started running ads in the app, which no one thought that they could do. And the same is true with PayPal now, has more and better data of transactions than even Amazon. It's just mind-boggling the business they can build out of this. And no one had priced that in. And now everyone's got to run to catch up. And guess what? This guy from Mizuno came out and said PayPal's got nearly 50% upside, a renewed bull says. And then when it gets to his 50% upside, he's going to upgrade it again. That's what they do. But this is a bold call considering where its sentiment is, and I give him a lot of credit. And what he's implying is he's talking about the fast lane offering, which crushes conversion ratios of all the competition, which we've talked about in past podcasts. Speeding up guest checkout. The offering could drive $1 to $1.5 billion boost to PayPal's transaction margin dollars over a medium-term horizon. That would translate in the range of price target. So he took his price target up from 68 to 90, 45%, 47% upside from new levels. He's also thinking that there's going to be multiple expansion, which we've been talking about since the first day we talked about PayPal on the podcast. This is from none other than Zero Hedge. Yen may ironically get help from the Fed of all places, and what he's referencing is the dot plot coming in June. We agree, and that will be a major impact on how we're set up. We're very excited for that opportunity and grateful that we had the last few days to put money to work from a big new group. By the way, hat tip to my new friends, well, my old friends, but new friends that came in size. So they were able to get bespoke service outside our normal raising window, and very grateful for that. I'll likely be doing a trip to China in August to meet with Alibaba and meet with some companies out there. And my daughter's going to be swimming with the China national team, I believe. I don't know. My wife just informed me yesterday, so I'm going to tie it all together. And then out in the Middle East in the fall to Dubai. So I'll be looking to set up meetings both in China and Dubai for anyone listening. With companies, with potential investors, etc. Fed rate cuts are coming. Get ready for the stock market's next phase. This is from Paul LaMonica at Barron's. And basically what he's laying out is the case that we've been laying out, which is REITs are going to get bid when this happens. Staples, healthcare, biotech, etc. Utilities have already gone, which we've been talking about for months. They got ahead because they didn't get the rate boost. They got the energy demand boost from AI. Blackstone executive says commercial real estate is bottoming. That's like asking your barber if you need a haircut, but take it for what it's worth. We knew, we were in and out of Vornado, had a great trade on that. Happened much faster than we expected last year. I think that if the high quality REITs get low enough, we may redip. I think obviously he's pitching his own book. I don't think we're near the bottom or at the bottom, but I do think if REITs get low enough ahead of the easing cycle, that the public market securities will price in the recovery 6 to 9 months before it begins to happen. So if REITs were very low right now, some of them are, but they're not low enough that they've really caught my attention again. And we thought that commercial real estate was going to actually bottom in reality 9 to 16 months out, we'd be a buyer now. So we wouldn't mind seeing REITs go lower before they go higher to get involved. Otherwise, we'll just take a pass. And we had a beautiful trade on Vornado last year. S&P 500 may be overbought, but most of its stocks are not. And I made a statement in the article of the week that are we buying the S&P 500 hand over fist? And our answer, we said, hell no. But we are aggressively deploying in individual companies, and we'll talk about that more in a moment. But this chart or table tells the whole story from Bespoke. And what he's showing is that as of the start of trading on Wednesday, only 42% of stocks in the S&P 500 were above their 50-day moving averages. So where are the opportunities? So utilities have run on this hot AI story, materials, technology, comm services, S&P. But then you got energy, which we've got our Comstock. You got staples. You got some consumer discretionary. Amazon is included in that, by the way. Industrials, real estate, a lot below. Financials, a lot below. And healthcare, biotech, a lot below. So lot to do, even if you're not chasing the indices, which would be the way that I would want to be thinking about it. Money supply rose for the first time in more than a year. So that is very constructive moving forward. It's been contracting. Alibaba raised $5 billion for share buybacks as it warns of AI challenges. So it converts at 105. They bought back stock at 80, which is awesome. They should do that all day long because the money only cost them, I believe, 50 basis points. And that's great. I'm going to talk a little bit about the Stock Connect at the end, which should help that situation moving forward, and they'll be able to deploy a lot more of that cash. A lot more of that cash into next year, into buying stock. Apple iPhone shipments in China rebound 52%. Market share loss to Huawei may be stabilizing. So two things, I think that's in line with what we saw with consumer deposits coming down. They're getting confidence back. They're starting to buy luxury again. And who wins in the luxury upgrade? Alibaba, Taobao, Tmall. Who wins in the junk commodity stuff? Temu, PDD. They're selling garbage at a loss. Baba is selling quality to luxury stuff at a profit, and that's going to be the theme moving forward. This is Joe Tsai and Eddie Wu's 2024 letter to shareholders. Definitely worth a read. You can Google it. But if you read through it, what I love about it is the Chinese are better than anyone else at copying. And here it's a copying combination between Jeff Bezos and Warren Buffett. If you made a hybrid of those two annual letters and operating principles that they follow and how they're thinking about the future, that's what you would find in this Alibaba. And if they were going to pick two mentors to deliver on their framework and strategy moving forward, those would be the two that I'd want them to pick. And that's exactly what they're doing. China, Hong Kong stock markets are back in favor with global investors. China growth story is very captivating. World is underinvesting. China is too big to ignore because of the significance in terms of wealth creation. Country presents huge opportunities for wealth managers. UBS Amy Lowe says, tell us something we don't know, but we like to hear. The rise in consumers' late debt payments is actually slowing down. So you got mixed messages. The mix is restaurants have to lower prices because they've been gouging customers for a while. I mean, a $15 Big Mac seems a little bit bananas to me. Even with inflation, it's grown, 3x versus inflation, has been up whatever. It should be, it should go from $5 to $8.50, not $5 to $15. And they're no longer getting away with that. So I think the consumer is okay, but I think the consumer is also saying, I'm not going to allocate that money for that quality. And to some extent, I think some of the fast casual places now, that are pricing around the price of the low-end fast food are going to be the beneficiaries. Maybe the Chipotles and the Five Guys and the Kavas and the Sweet Greens, etc., and will maybe do a little bit better because you're getting much higher quality food for about the same price as the garbage, because the garbage prices have come up so much. I'm all for garbage too every now and again. Alibaba invests $27 million in education startup to expand its generative AI portfolio amid price war in China. Alibaba is one of China's most prolific AI venture investors with stakes in all four, quote, new AI tigers, namely Moonshot AI, Baichuan, Zippu AI, and Minimax. So, like we said a couple of weeks ago, if you were to invest in a Chinese AI ETF, it would be ticker BABA. Okay. Hope that connects for most of you listening. Rich Lee states strong confidence in Hong Kong economy. He basically points out that Hong Kong's, has been through the financial crisis in 1997, the dot-com bubble, 2 pandemics, the great financial crisis. It always comes back. We agree. And that's the basis. What people get stuck with is recency bias, and they extrapolate what's recently been the case, which is no demand for or uninvestable China will persist forever. You take the other side of that. That's how fortunes are made. IMF ups China's 2024 GDP growth forecast to 5%. Container throughput at China's ports up 9% in January through April. China's mutual fund top record of $4.1 trillion as investors shift out of deposits amid bond rally and stock rebound. So some of those deposits are going back into risk assets, which is a big deal. Father of emerging markets, Mark Mobius, turns bullish on China stock as property measures restore confidence. Last month, he said China stocks were not attractive. Now he says they are beginning to look good. He's an 87-year-old fund manager. Recent trip to southern China where he saw signs of recovery firsthand had an impact on his thinking as well. Article of the week, should I be worried? Stock market and sentiment results. Here's our friend from Home Alone. So we covered the Fox business. The beauty and fun of live TV is that you have to be flexible. Here are the show notes I had sent ahead of time. So what was I talking about in terms of the market and economic outlook? 78% of companies reported positive earnings surprise. 61% reported positive revenue surprise. Earnings growth came in at 6% for this quarter versus estimates of 3.2%. The 12-month forward PE is 20.5. 19 times is versus 2025 full year estimates, and earnings growth for this year is expected to be 11.4%. That's a key number. What's a more important number is for 2025 are estimated to be 14.2% earnings growth. So remember those two numbers, 11.4% growth this year, 14.2% next year. Atlanta GDP now pointing to 3.5% for Q2 growth. And this is one of the key things that we want to cover here is June through August are the 3 strongest months of the year during the 4th year of a presidential cycle since 1928. What are the stats for June through August during the 4th year of a presidential year? Average return is 7.3% for the S&P 500, up 75% of the time. This is doesn't mean it's going to happen. It just means the odds are in your favor. Time for dividend stocks. A high dividend yield is the second most neglected factor at 51% underweight for managers. This is data from Bank of America. This basis could be a risk to fund performance this year as we see many reasons for high dividend yields to lead. First and foremost, high dividend yield leads in recoveries and global upturns. We covered a lot of the data that happens around massive global recoveries. those are what we're seeing in place. Trillions of US dollars in cash in retiree accounts. If short rates fall below 5%, which is basically a cut and change, flows would seek equity income. The capital gains is just a whipped cream on top of that because the dividend yield is going to start to be back in demand. And then 85% of S&P stocks offer higher dividend yield over the next 3 years than cash, assuming short rates peak here, which I think is a fair assumption. Capital appreciation is just gravy. Dividend yield is unloved and cheap after 2023's credit scares. So you can see the long-term chart as we've covered several times in recent months on the podcast. This is when you buy. Where do people get stuck? They believe that they get stuck in recency bias. What's happened recently is going to persist indefinitely. And what we see when we look back after many decades is the relative underperformance has been at these levels many, many times, and it always precedes massive outperformance over many, many years. And I think that's exactly where we are with dividend yielders, with small caps, with emerging markets, etc. And then I was poised to speak about two dividend payers. One is Crown Castle, down 48% off its highs, 40,000 cell towers, which is about 68% of its revenues. 9,000. They have the small cell fiber business, which the spending has stopped. Now they're starting to monetize. The new CEO, Stephen Moskowitz, 25 years in the business, 12 years at the number one player, American Tower, is the new CEO. He'll decide whether they're going to sell it or make it work. I think they're going to be selling that, and they're selling from a position of strength. 6.3% dividend while you wait. These are great businesses with a great moat. And as rates moderate, what's going to rally? REITs are going to rally. They trade like bonds. And the second one, Stanley Black & Decker, down 58% from its all-time highs. As you know, if you've been listening for some time, Stanley, DeWalt, Black & Decker, and Craftsman, infrastructure and construction. Remember the IRA Act, lots of spending there. And then as rates come down, you're going to see more and more construction once again ramp back up to meet the demand for housing supply. Every house that's built, they're selling the tools that are being used to build it. Talk about literal picks and shovels in the gold mine that is providing enough housing supply for 72 million millennials age 34 that are starting families and want a house. They reduced their over inventory from COVID by 1.9 billion. Their gross margin is up 10% year on year to 29.6, headed toward their target of 35. And their cost savings now are executed on a 1.5 billion run rate from their $2 billion target. So they've got a lot of the stuff done. If you just do the math on the $2 billion savings, that's about $13.25 a share. Their average historic multiple is 16 times, which implies $212 a share, meaning a ton of upside, 3.76% dividend yield while you wait. Okay, so we covered that. We covered the seasonality of this. So you can bet against this seasonal summer rally. Bet against these odds after a few days of volatility, or you can burden yourself with the facts from my notes above, which we went through. Now, this is a very important concept, and I don't think you'll hear it anywhere else because I've never heard anyone else talk about it in the way that I'm going to talk about it to you right now. So I think you're going to find it helpful. Multiples may seem high right now, but when you compare them to earnings growth, they begin to make more sense. Think of it as you would a PEG ratio, price to earnings growth ratio, on an individual stock. People don't mind paying 30 times earnings for a stock growing earnings at 20%. That's a 1.5 PEG ratio. That's a reasonable valuation. But 30 times would be very high for a company growing earnings at a more modest 6%. Now you're talking about a 5 times PEG ratio. The multiple divided by the earnings growth ratio, that's too high. So if you zoom out, while the 19 times 2025 EPS multiple seems high because the 10-year average PE was only 17.6, you have to put it in context. S&P 500 earnings growth historically averages high single digits. For example, from 2000 to 2024, 24 years, S&P 500 has grown from $56 a share in earnings to $244 expected for 2024. That is about 6.32% earnings growth per year. So if the average multiple was 17.6 times on 6.32% earnings growth, you had a PEG ratio, price to earnings growth ratio, of 2.78, which is considered expensive if you were looking at an individual stock. However, we're now trading around 19 times 2025 estimates, which implies 14.2% earnings growth. So remember, we grew earnings high single digits, 6.32 over 24 years. We're growing this year at 11 and change. We're growing next year at 14.2 earnings growth. So while the PE multiple 19 times is a little higher than the 10-year average of 17.6, the earnings growth rate is more than double. So the PEG is only 1.34. This is considered on the cheaper side as it relates to PEG ratios. Peter Lynch became famous for using this ratio to find individual stocks, but I've never seen anyone talk about it in detail as it relates to general indices. If you applied the historic PEG ratio of 2.78 times to 2025 earnings growth of 14.2%, you'd get a PE multiple of 39.47 times. If you applied the historic PEG ratio to 2024 earnings growth of 11.4%, you'd have a PE multiple of 31.69 times. Taking the mean of those two for 35.58 times 2025 estimates of 278.84 earnings, and you get to an S&P at 9,921. Do we expect anything like that? Hell no. But it puts things in perspective when people say multiples are too high, but they do not take the time to ask the question, relative to what? In other words, a 5 times PE ratio can be too expensive if you're only going to grow earnings at 1% per year, just as a 40 times PE multiple can be too cheap if you're going to grow earnings at 50% per year. Does this mean we are pounding the table to buy the S&P index hand over fist? Again, hell no. But it does mean we're aggressively putting money to work in individual companies that are excessively undervalued relative to what we believe their normalized earnings power will look like as the recoveries and progress continue, which is why the number 2 things we look for in terms of runway for turnaround back to normalized earnings trend is solvency, i.e. balance sheet, interest cover, refinance risk, and number 2, free cash flow. Cash is king, and if they have the free cash flow, and they have an okay balance sheet, they'll have the runway to execute on the recovery back to normalized earnings where you get multi-baggers. For instance, Alibaba will return to double-digit earnings growth while trading at a single-digit PE currently. We have about a dozen or so of these diamonds in the polishing machine. So you can see the polishing machine here. Some are already shining up 50 and 100% plus. Cooper Standard, Amazon, Google, SMTC, Generac, Rolls-Royce, which we took profits on last year, Range Resources, etc., and a lot more room to run. Others are still in the polishing machine getting buffed and will come out as multi-baggers over time. We've discussed several on our podcast VideoCast, and the rest are known by our clients when they look at their portfolios. Charts I'm paying attention to. We'll discuss these in greater detail on the podcast VideoCast tonight. If you're not on our email list yet, you can sign up at hedgefundtips.com/podcast. Also, you can sign up for get a weekly text when it's hot off the press. Go to hedgefundtips.com and you'll see at the top, join free Hedge Fund Tips text club for first access to our weekly stock market commentary. While you're there, click on terms. This is all opinion, not advice, for informational, educational, and entertainment purposes only. Do not act on any of the information without consulting your financial advisor. We'll also have our full disclaimer at the end of the podcast with our new great music to accompany it while you read it. If you're listening on the podcast, go to the website, and read it, or watch the YouTube video, click your pause button and read it there. Moving right along. So here are the charts I'm paying, and by the way, you can remove yourself from either of those charts I'm paying attention to right now. This is the equal weight index of the S&P 500, and this points to what Bespoke was saying about 42% of the S&P's trading under their 50-day. Only 42% are trading above their 50-day moving average. So this is my Great Hill Capital mug, which matches the backdrop TV from my friends in Texas. I appreciate it very much. I use it every day. So it looks like a break. Maybe it'll go retest this before it recovers. Maybe it'll just take off from here. S&P, a few of the heavyweights are holding this thing up. It's broken out. I could definitely see the equal weight start to outperform based on the catalyst we've discussed. Semiconductor, same thing. XBI here, right around the volume by price, holding in here. I think this starts to move aggressively higher based on the catalyst we're talking about. Interesting that it looks similar to the regional banking ETF. So all of these are set up, which looks eerily similar to the emerging markets ETF, which looks eerily similar to the KWEB China Internet ETF, which looks eerily similar and is contingent upon what? Contingent upon US dollar working back off this counter trend rally, which it has been, and TLT yields moving up as it has been and continuing forward. Fear and greed, neutral, and we covered the National Association of Active Investment Managers. Earnings. ARK Innovation Fund earnings estimates and revisions, top 30 weights of Cathie Wood's fund. Earnings estimates are up 108% in the last 60 days for this year, 59% for next year. So as much heat as she's taking, I think she had one of her companies blow up after earnings yesterday. I do think she's going to get a bid as rates becomes clear we are going to get the 1 or 2 cuts this year, which people are now not expecting. Why? Recency bias. Just as they were so certain we were getting 7 cuts this year, they're now so certain we're getting none. And you see it in sentiment, and that means it's probably the truth is somewhere in between. And I think that's going to be 1 or 2, and it's going to help along with the other groups we said, groups like this. Longer duration, oil and gas equipment service earnings, top 30 weights in the last 60 days, down 3.83% for this year, 2.61 for next year. The interesting thing about these earnings is not only they held in through all this noise and wars and political stuff all year, they're going back up, and that's the name of the game. Now, we've got quite a few Ask Me Anything questions this week. So for those of you who just tune into the podcast, we're done. We'll be back next week, same time, same place. Make it a great one. For those of you who love the Ask Me Anything questions and get a lot of value, we're going to kick that off right now. And these tend to go for a little while, but we dig in. When Alibaba is dual listed on the Hong Kong Stock Exchange and included in the Stock Connect program, would that allow them to use their $60 billion of cash inside China under capital controls to repurchase shares without needing to move funds out of China? The answer, Kokwan Unosawa, is, and I'm talking with Brendan Ahern on this, I'll confirm it next week, but from the research that I was able to do, the answer is yes. So Stock Connect program allows investors in mainland China and Hong Kong to trade eligible stocks listed in each other's markets. March 2023 was expanded to allow eligible international companies primarily listed in Hong Kong to be included in southbound trading for mainland China. This means once Alibaba obtains primary listing in Hong Kong, mainland Chinese investors in companies like Alibaba can buy and sell Alibaba shares through the southbound Stock Connect link. Alibaba has been aggressively buying back shares, spending $12.5 billion in buybacks in 2024, funded partly by its ample cash reserves in China. With a Hong Kong primary listing, Alibaba can directly utilize Chinese cash holdings to repurchase its shares through the Stock Connect southbound trading link. So in summary, the expansion of the Stock Connect program enables Alibaba to tap into its substantial cash reserves in mainland China to fund share buybacks once it is primarily listed in Hong Kong, provided a new avenue to support its stock price. I think that with the 180 to 210 new potential buyers that will be coming on board from mainland China, they're not even going to have to buy back their stock if they don't want to, because there are going to be so many natural buyers. So this is the information I have right now. I will talk with my buddy to confirm that on next week's call, who has more nuanced information on this and a report on this. But look, it doesn't really matter once you have the 180 to 210 new buyers, but it would be a nice additional thing. So let's just say 85% certainty with this right now, and we'll get more certainty by next week. At the end of the day, it doesn't really matter because you're not buying the stock for buybacks. You're buying it. I mean, buybacks matter, but you're buying it based on the China recovery. But good question, and that's the best answer I have at this second because I've only had a little while. All right, moving along. Mark S., thank you for all your videos and sharing your thoughts and knowledge. My question is about the VIXI or the VXX. Have you ever bought it in your career? Would you consider buying at these low levels? Yes, I'm aware how you hedged your positions in last months. Thank you for your thoughts, Mark. No, they're dog poo-poo instruments with negative roll yield. So no, it's garbage. They're rolling futures. You're going to lose money. You might get lucky on a random day, just like you might get lucky hitting 28 on the roulette wheel, but dumb way to trade and like guess like when the market's going to be volatile. Like, anyway, so yeah, I've shared how I've hedged different ways, and that's a better way to do it if you think you have an edge. And I think it's, anyway. Rashid Zain, curious as to why you bought GXO instead of XPO and RXO. We covered this when I initially announced GXO. XPO's already left the station. RXO, I don't like the business as much. GXO is perfectly timed. As a matter of fact, I thought it was interesting. Forward Air, which has completely been decimated, had a new activist come into the stock. That's kind of like the lowest quality in the logistics business, and they're getting sniffed out. So I think you're going to see more and more of that, and GXO is in a good position for that, and that's why we like GXO. Short answer. Long answer, go back to the past podcast. Jacob Saxtoff, do you see Bristol Myers Squibb as a great value or more like a value trap? I think it's a pretty good value here. We've covered that a few times. We're not doing anything with it. Mitch Lim asked the same question about the BABA buyback. 85% sure on that. He asked it again. Don't send in questions twice, guys. I'm either going to answer it or I'm not. Don't need the 3 or 4 emails for the same question. Daniel D, short-term thoughts on First Solar and Deckers, please. More upside. Try to keep these to one question each, ladies and gentlemen, because we're now grateful and getting a lot from all of you, and we got to keep this thing under 5 hours. Yeah, I'd like to get some renewable. The irony is, if, and I don't play politics in investing, but the irony is everyone thought that if Trump got elected, energy stocks would do well and China would collapse, and the exact opposite. China stocks did amazing under Trump's tariff regime, and oil stocks did horribly. And I think the same is true. And renewables did horrible under Biden. I think if Biden is elected, you probably want to buy oil stocks, and if Trump is elected, you probably want to buy renewables. So leave it at that. First Solar, I'm not interested at these levels. I don't buy up. It's just not what I do. I buy them when they're out of favor, and you can play the momentum game, and some people are successful day traders doing that, and there's tons of way to make money, and that's why I tell a lot of young kids, they think they want to be hedge fund managers. They have no idea what it takes, and they could be probably very successful just investing in real estate or starting a small business or rolling up a few businesses. They're not going into investment management because they love it and it's all they want to do 24/7 like I am and many successful investors are. They're in it because they think it's the highest paying job they can get, and that is a guaranteed formula for failure. guaranteed formula for failure. You will never compete with people who do this 24 hours a day and love it. Deckers, I mean, I don't buy things up. So Daniel, for me, it's no and no. It doesn't mean they won't go higher. Oz Smadja, really appreciate your podcast. I live in Israel. Vans is really popular here. I own 3 pairs. I'm not even a skater. I know your cost is on ASOS. I want to see better execution. Return to normalized inventory. Clear some old stock. They sold 83% of their winter inventory. Positive free cash flow, liquidity for 2 more years. Supported by new inventory. 60% of sales were made without promotions. Hired a new CFO who worked at Amazon and Sainsbury. Seems like the tough period's over. Much higher margins. Starting. What's your opinion on this? Look, we still have a position. Nothing that they've said yet makes me want to lean into this position yet. But I am watching it like a hawk. And the moment that I get confidence in management and their ability to turn this thing, I will be leaning in. And at the end of the day, it really doesn't matter if I buy more at $5 or if I buy a ton at 10. If this thing's going to turn, it's going to turn hard. So I'm not worried about it, and I'm watching it. And we'll know when it's time to get aggressively involved versus passively involved. And now is not the time just yet. Bill, continued great work on your podcast. Would you give me Bill McGrew opinion on Cantaloupe CTLP? Already realize you have exposure via PayPal. Okay. CTLP. Okay. All right, so they're turning cash flow positive. See what their balance sheet looks like. First off, what do these people even do? Digital software payments. Okay. Financials. All right, so they are growing. It's a tiny business. They're growing revenues, albeit at a slower pace, from 10% growth to from 20% growth to 10% growth. That's not really what you want to see in a small cap, but let's just assume it's an anomaly. Negative earnings to positive earnings, so they might be turning the corner. Let me just make this a little smaller so you can see what I see. Balance sheet, 12 million in cash. I'm sorry, that's not the balance sheet. That is the cash flow statement. Let's see what they're doing in free cash. They've been consistent losers until recently. They had 1 good year of free cash flow. That's a little limited, but moving in the right direction. They've been a consistent destroyer of capital. That seems to be turning the corner. And 50 million in cash. 36 million in debt. Looks okay. I'd say it's probably worth it. The reason I don't play with this type of business is because it's not big enough that I can lean in. So I'd rather do a company like PayPal where I could buy a good amount of stock, do some long-dated derivative overlays, and get excess return through the combination versus just taking risk in a lower quality business that could be, destroyed by competition and doesn't have a moat to fight off. That said, this does warrant further analysis if you're going to do a small cap company. So there's nothing here that I don't like. I think it is turning the corner, but you really have to understand its competitive advantage and why they matter. Why, if they stopped existing tomorrow, would it really bother anyone? What's their unique selling proposition? So I don't have the answer to those questions, but I would say the numbers are good enough that it's worth a look. Nice find. Vinay Desai, thoughts on Whirlpool? But I think we covered this last week or the week before. It's okay. The thing I don't like about it and why we haven't done anything with it is that I like it on a housing story because they're just turning negative free cash flow, and I don't like this. I mean, it's been a consistent negative trend. But if I'm right about rates starting to come down a hair, building's going to go bananas, and Whirlpool is going to be a beneficiary. It kind of trained with Stanley Black & Decker and Generac, and I have enough exposure from them with, in my view, less risk and more reward. I don't know that the dividend is going to be safe, by the way. So if you're buying it for an 8.3% dividend yield with a negative free cash flow company, you have to assume the dividend is going to be cut. And if you're okay with that, let's just take a look here again. So this is the other thing I don't like about this business. It hasn't grown revenues in like a decade. So it has nothing to do with the pandemic. They just aren't growing at all. I don't like that. So they deserve a low multiple. Let's see if they've grown cash flow at all. And the answer is no. It's been going down, down, down. Profitability. So look, I think it probably works for a trade because it came across my radar too. I just don't see any. I'd have to really understand what their plan is for turnaround other than just a rising tide in home building will lift all boats as we look a year to 2 years out. But I got better ways to play that. So highest and best. The good is the enemy of the better is the enemy of the best. I think this is good, but it's not better and it's not best. And I think I have those. So for me, it's still a pass, but I continue to keep an eye on it because I know how you got here and I like your thinking, but I need to see a little bit of trends. And if I miss it, I miss it. Totally happy for that. Okay, Frank Brown. All right, he's asking about Zoom and Sentinel-1. I think Sentinel-1 I've been looking at. Zoom I looked at in past. Revenues seem to be flatlining. I mean, they'll have a great kind of annuity business. I don't think there's going to be massive growth. I think they're just going to probably keep a lot of what they have if Microsoft doesn't just try to destroy them and just make it impossible to use anything else but Teams, which I think they're probably trying to do. Free cash flow is fine. It's okay. I mean, there are higher and better uses. For me, I don't know, Zoom, let's just see, ZM. I get it. Maybe. I just don't see, it's a one-trick pony. There are no outs like you have with Baba. You got the cloud, you've got all their AI investments, you've got the recovery of the consumer, you've got all these other assets that they have that they can monetize, you've got the international growth, you have so many things. This is like, it's a commodity video thing. It's like, do I care if someone sends me a Teams link versus a Skype link versus a Zoom link versus a, I don't even know how many there are. Google Meets, which is free. I think their cash flows are probably fine. I just don't see how they grow. And if they don't grow, I don't see how we get a recovery here. But it's worth listening to the calls and doing the work based on the financials. But all right, Sentinel-1, they've only been around for 5 minutes. So for me, it's usually a pass. But let me just take a look. I don't know why. I think I looked at this one already. Let's see. Still free cash flow negative, so it's probably a very short look. Cybersecurity provider. Yeah, so for me, I have no edge here to see which one has the moat and which one's going to be durable. Tiny company. It's growing right now. Free cash flow negative, probably with a great story about the future one day. Now, this is not for me. Too early for me. Hard pass. And that's that. Thanks for sending them in, Frank. Byron Firestone. I've been watching your podcast now for about 2 years. Must say you've been a huge help for me as to learn what to look for in companies. Really appreciate what you do for your audience. Thank you, Byron. My pleasure. And thank you for listening. I appreciate you being a 2-year listener. Very grateful for that. Hope this question finds you well. What are your thoughts are on Cracker Barrel? This one has come across my thing. I kind of like it here. I mean, the pessimism, again, recency bias is people extrapolate what's happened in the recent past is going to persist. Fortunately, unlike Red Lobster, Cracker Barrel is not owned by private equity, and they do not sell unlimited shrimp. I think this one is going to be all right. It's just not ready yet, in my view. I think there needs to be a couple more bankruptcies in the group. I think there is probably a little bit of oversupply of these chain restaurants, but this thing is a legend. And the free cash flow, although it's declining, it's okay. The revenues are okay. I like this now or soon. Let me just double check the balance sheet. And if I remember, I think Sardar Biglari owns this in size, or one of his insurance companies do. Let's see. Ownership. Yeah, Biglari Capital Corp. This guy's pretty good with restaurants through the years. He will not, it's unlikely he'll let it fail. I would just like to see it down a little bit more before I get excited about it. I may not get that. Let me just take a look at the numbers here. So, yeah, so they've been growing. They must have added a bunch of stores. Let's see what's happening to the margin here. And the share count. Share counts, they respect equity. That would make sense with Biglari at the helm. And free cash flow. Free cash flow has been declining, but still positive, so they got runway. Let's see. Maybe it's the balance sheet. If it's this is the issue. The balance sheet, cash, a lot of $500 million of debt, 12 million of cash. I got to double check these numbers because sometimes they're wrong. But that's why it's trading down as solvency risk. So you want to get to the balance sheet and see when everything matures, what's their plan, listen to the last few calls, what's management doing about refinancing the debt, what do they have on their balance sheet they could sell to create liquidity, because if you can get comfortable with their solvency, you're probably going to have a double or a triple over a few years, but they might get stopped out if they're too leveraged and they can't hit the window. So that's why it's trading down 66%, is because there is a solvency risk. And if you can do the work to figure out whether that's real or fake and make a probabilistic bet, that's how you can get multi-baggers. But you could also get a goose egg. So do your work before you invest. Andreas Johnson, thanks for the Best Finance podcast. I'm very grateful for that, Andreas. That's very kind. Already recommended to several friends. Thank you for that. That's most important. If you're getting value from this, one, thanks for listening and tuning in every week. And number two, the greatest compliment you could pay me would be to share it with at least one or two friends who you think who would also benefit from it. That's how we grow, and that's how we can keep doing it for a long time, not only for clients, which we'll always do it for, but non-clients alike, which we've been grateful to do it for. BGFV, a company you would have on your radar. Let's take a look. BGFV. This is probably going to be another refinancing risk company, just looking at it, but let's burden ourselves with the facts. All right, so it looks like the revenues are getting crushed. This is Big Five Sporting Goods. Dick's just blew out. Had great earnings. Free cash flow's okay. You got to understand why are the revenues down so much. So that's number one. Gross margins are declining. So is that secular or cyclical, or is Dick's destroying them? And that's the analysis that you can only do with hours of time on the calls, reading the public filings, annual reports, looking at the bear thesis. First, revenues continue to decline. I don't want a business that's declining unless there's a really damn good reason why those revenues are declining. Losing money. Barely free cash flow positive. What's the balance sheet look like? $12 million of cash. No long-term debt. A lot of leases, but okay. This is a little too hairy for me, but if you dig in and you can be certain about solvency, you could probably take a punt at it, but you really have to get comfort as to how are they going to turn around revenues, or are they just toast? But nice find, Andreas. Thank you for all of that. With that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.